Peru's southern mining corridor stands empty. Trucks loaded with concentrates from Las Bambas, Antapacay, and Constancia mines, accounting for over 13% of global silver output, aren't moving. That's 108 million ounces annually trapped in logistical limbo, while Mexico's regulatory freeze idles another 185.7 million ounces, pushing the at-risk supply to 35% of the world's 850 million ounce production. Silver spot hit $67 per ounce, up 128% this year, but dealers report premiums spiking 15 to 20% on physical bars. Inventories drain, lease rates in London climb to 8 to 9%, signaling banks can't lend metal they don't have. This disconnect isn't market efficiency, it's the system fracturing in real time. I see it in the numbers first. Global production already on a negative 0.9% CAGR trajectory toward 901 million ounces by 2030, before these blockades accelerated the decline. Peru's output, projected for a meager 2.4% rebound to 110.8 million ounces in 2025, now faces indefinite disruption, sliding toward a negative 0.8% annual drop by decade's end. Mexico fares worse, a negative 2.9% CAGR to 200.6 million ounces, locked in by a de facto concession ban since 2018, now formalized in congressional reforms targeting open-pit methods that deliver 60% of the country's mining value. These aren't isolated policy tweaks or protest flares. They're synchronized signals of a supply chain losing grip, where metal extracted doesn't equate to metal available. Look closer at Peru's corridor, a 482-kilometer vein pulsing through Apurimac, Cusco, and Arequipa, feeding ports with $12 billion in project value. Informal miners from Confami, Peru seize it, demanding formalization without environmental strings, extending deadlines that expired in July 2025. This isn't negotiation, it's siege warfare on infrastructure. Las Bambas, pumping 2% of global copper and byproduct silver, has logged 600 days of stoppages since 2016, nearly 2 years offline in 8. Now, with coordinated actions amid President Dina Boluarte's legitimacy crisis, the highway resembles a battlefield. Burning tires, jammed routes, illegal trucks from artisanal operations flooding in, accidents multiplying after dark. Mines operate, ore piles up, but without transit, that silver evaporates from global flows. Physical absence trumps paper promises. This mirrors 1970s oil embargoes, where supply choke points didn't just raise prices, they exposed systemic dependencies. Back then, OPEC's cuts revealed how industrial economies hinged on uninterrupted pipelines. Today, Peru's blockade uncovers silver's fragility as a byproduct. 72% of output rides on copper, zinc, lead, and gold operations, only 28% from primary silver mines. Antamina, Peru's giant, yields 12.63 million ounces of silver yearly as secondary to copper and zinc. Disrupt copper logistics, and silver vanishes without fanfare. Investors fixate on copper hitting multi-year highs for data centers and EVs, missing how each ton withheld erases byproduct ounces. The logic held in stable eras. High margins from primary metals subsidize silver extraction. Now, with blockades compressing those margins, alternative routes add fuel costs, delays, breakdowns. The equation flips. Silver becomes the invisible casualty. Inventories tighten unseen. China's moves amplify the fracture. Third largest producer at 3,300 metric tons in 2024, down from 3,400 the prior year. They're not just declining, they're restricting bullion exports, spiking in September-October 2025 before clamping down. October saw 660 tons shipped, a record flood to ease London's tightness, but now premiums on Shanghai spot exceed 15%, dwarfing the 13% import tax. This isn't benevolence, it's strategic hoarding. Undisclosed reserves build while feeding Western demand, positioning China to absorb shocks. When Peruvian shipments falter and Mexican concessions stall, China's imports, averaging 310 tons monthly, could surge, draining vaults in London, New York, Zurich. If you track commodity flows in Asia, how does this export pivot to restriction align with what you're seeing on the ground? Share your observations in the comments. It could clarify where the metal's really pooling. History echoes here. The 1980 Hunt Brothers squeeze compressed silver from $6 to $50 in months, not through production halts, but market cornering. Mechanisms worked then. Regulators intervened, supplies normalized. Today, no such reset. 5 straight years of deficits have depleted buffers. Inventories sit at critical lows, no slack for disruptions. Pre-2020, silver cycled predictably. Surpluses from byproduct booms offset industrial dips. Now, With mine closures accelerating and permitting stretch to 7 to 10 years, supply can't elasticize. Geopolitics layers in. Mexico's hostility to foreign investment under López Obrador's legacy. Peru's weak governance, fueling informal sector aggression. Where once logistics adapted, rerouting, stockpiling, now chaos reigns. Illegal mining trucks clogging the same corridor, turning efficiency into entropy. Shift to consequences unfolding. U.S. Industrial demand, subsidized by the Inflation Reduction Act and CHIPS Act, devours silver for solar panels, 20 grams each. EVs, 5G, data centers, military tech. Over 50% of output feeds these sectors, with photovoltaic demand up 64% recently. Global solar capacity doubled 2023 to 2024, set to double again by 2027 to 2028. Exponential pull on a contracting supply. India's imports hit 2,600 tons in September to October 2025, signaling emerging markets joining the fray. Lease rates at 8 to 9% scream tightness. Banks charge premiums to lend metal they scramble to source. Paper prices lag physical reality, 67 spot, but dealers add 20 to 30% for bars. Delivery waits extending weeks. This gap, paper complacency versus physical scarcity, marks the system's core instability. Compared to 2008's commodity crunch, oil spiked on demand-supply mismatch, but new shale unlocked relief. Silver lacks that. Capital for new mines runs $500 million to $2 billion, deterred by risks in top producers. Mexico's open pit ban threatens 1% GDP shave and 200,000 jobs. Yet pragmatism evaporates under Sheinbaum's review. Initial hints of lithium exemptions mask deeper concession droughts. Peru's winter looms. April-May disruptions, likely worsening blockades. If you're in logistics or supply chain management, does this corridor chaos echo patterns you've encountered elsewhere? Drop your insights in the comments. It might reveal broader fracture lines. The cascade builds. Q1 2026. Chinese New Year restocking collides with post-blockade voids. February-March. U.S. solar ramps. By June, industrial users face Q2 shortages. Bidding wars ensue. Analysts project $100 to $125 per ounce by late 2026. Triple digits in bull cases. Conservative, given 120% YTD gains outpacing gold, ratio tightening to 65 to 1 from historical 40 to 50 to 1 norms. If gold holds $4,300, silver could chase $100 plus to realign. But this underprices the break. No quick fixes for siege highways or frozen regulations. Deeper, military angles intersect. Silver's conductivity powers defense systems. Antimicrobial properties aid medical gear. U.S. modernization demands spike amid global tensions, yet supply chains trace to unstable regions. Pre-World War II, strategic stockpiles buffered metals. Today, undisclosed Chinese reserves suggest asymmetric preparation, where systems once balanced through trade pacts and investments, now nationalism fragments. Mexico's restrictions deter FDI. Peru's protests demand profit shares, eroding corporate control. India's surge adds torque. 2,600 tons imported in 2 months, outstripping norms. As emerging demand converges with Western green transitions, the squeeze intensifies. If you followed Indian or Asian markets, how does this import spike fit with local industrial shifts? Your perspective in the comments could connect dots on demand-side pressures. Structural vulnerability peaks in byproduct dynamics. Copper mines prioritize revenue from the primary metal, sidelining silver in crises. Las Bambas' stoppages defer maintenance, drop efficiency, heighten labor strife, cascading to full halts. Earlier mechanics absorbed this. High copper prices offset losses. Now, with EVs and AI inflating copper needs, disruptions amplify across metals. The logic fractures here. Silver's invisibility in calculations delays market response, baking in 6 to 12-month shortages. Global mine closures compound. Aging operations shutter without replacements, deficits persisting. China's hoarding flips the script. Exports flood, then restrict, manipulating tightness. London's stress radiates. 8 to 9% lease rates indicate lenders rationing, foreshadowing delivery failures on futures. If you're analyzing commodities historically, does this byproduct trap remind you of past metal squeezes? Weigh in below with your comparisons. It sharpens the view on why silver's different now. Transition to endgame. No cavalry. New projects stalled. Alternatives erode margins. Panic phase nears. Manufacturers hoard, outbidding investors. Paper contracts decouple from physics. Premiums balloon, dealers halt sales. This isn't cycle. It's regime shift. Repricing silver in an electrified world. Forecast lag. Banks raise targets post 120% move, confirming fundamentals flipped. Bull case $200 if chains break fully. Mexico bans pass, Peru's government falters. Corridor stays offline a year. Crisis. Rationing, stockpile releases, worthless contracts. If you've modeled these scenarios, what price threshold signals full panic in your view? Share in the comments. Collective input maps the trajectory. The process accelerates unchecked. Deficits deepen, inventories vanish, demand explodes. Systems lose stability at choke points. Regulatory, logistical, geopolitical. Exposing dependencies long ignored. Metal flows halt, prices chase scarcity, economies recalibrate. This fracture defines the phase. Control slips, adaptation fails, reality asserts. One final layer. Informal mining's rise in Peru signals parallel economies clashing with formal chains, fragmenting supply further. Confami's demands aren't resolved overnight. They embed chaos. Mexico's GDP hit underscores economic fallout, yet policy inertia prevails. If you're in policy or economic circles, how do these regulatory signals stack up against historical precedents? Your take in the comments could illuminate paths forward, or their absence. The systems in mid-collapse. Peru offline, Mexico paralyzed, China guarded, demand unrelenting. No reversal in sight, just deepening imbalance. This is the reality now. Cold, inexorable, measured in ounces undelivered. London's vaults bleed silver at rates unseen since the 1980 squeeze. 1-month lease charges hit 8 to 9% annualized in mid-December 2025, while physical dealers quote premiums of 20 to 30% on kilobars. Numbers that scream scarcity, not speculation. Spot trades near $67 per ounce after a 128% annual surge. Yet COMEX registered stocks hover below critical thresholds, and LBMA inventories refuse to rebound. This isn't volatility. It's the market admitting what production figures already confessed. The 5th consecutive year of structural deficit, now exceeding 149 million ounces, with no reversal mechanism in sight. The fracture widens because silver's supply elasticity vanished years ago. Primary mines, those drilling explicitly for the metal, deliver only 28% of global output. The rest tags along as byproduct from copper, zinc, lead, and gold operations. When those primary hosts falter, silver output collapses silently. Peru's corridor disruptions in mid-2025 shave millions of byproduct ounces without headline alerts, while Mexico's lingering concession drought, new awards frozen since 2018, open pit reforms under perpetual review, locks in a negative 2.9% CAGR trajectory. Global mine production stalls near 813 to 835 million ounces, flat or declining despite record prices. Recycling rises, yet fails to bridge the gap. Here's where the logic breaks. High prices normally summon new supply within 18 to 24 months. For silver, lead times stretch 7 to 10 years. Capital demands $500 million to $2 billion per project. And geopolitical risk deters commitment in the dominant jurisdictions. China's pivot seals the containment. Domestic output dipped to 3,300 metric tons in 2024. Exports flooded briefly in October. 660 tons to relieve Western tightness, then restricted sharply from November. Shanghai premiums exceed 15%, arbitraging metal eastward into undisclosed reserves. If you're tracking Asian flows, does this retention pattern match domestic stockpiling signals you've observed? Your read in the comments could pinpoint how much metal truly exits global circulation. Demand, meanwhile, accelerates without restraint. Industrial offtake, over 50% of total consumption, hits successive records, led by photovoltaics claiming 20 grams per panel amid capacity doublings. U.S. subsidies via IRA and CHIPS act fuel solar ramps and semiconductor fabs. China's grid expansion devours more. India's infrastructure build-out joins the pull. EVs add 25 to 50 grams per unit. AI data centers multiply conductor needs. 5G infrastructure layers in. No single sector dominates alone, but their convergence creates exponential draw on a rigid supply base. Military applications, conductivity and guidance systems, antimicrobial coatings, intersect quietly, yet reliably, as modernization budgets swell. History provides the mirror. The 2000 to 2011 bull run saw silver climb from $4 to $49 on emerging industrial themes, yet resolved through new primary mines and byproduct surges from base metal booms. Today, those responses fail. Aging ore bodies close without offsets, permitting grind slower. Community conflicts embed delays. The 1980 hunt corner compressed prices artificially upward, then collapsed on regulatory intervention. Current tightness emerges organically from physics. Ounces extracted versus ounces required, with no quick regulatory off-ramp. Lease rates at 8 to 9% expose the stress point precisely. Lenders demand compensation reflecting delivery risk. Borrowers pay because alternatives vanish. This isn't transient noise. It's the cost of immediacy in a market where forward supply contracts decouple from spot reality. Physical premiums follow. Dealers halt quotes on certain products. Delivery stretches months. Smaller units command 50% markups. Paper markets lag, allowing brief contango, but physical bids erode that buffer relentlessly. Compare to oil's 1970s shocks. Embargo choke points revealed dependency. Prices quadrupled, yet new provinces unlocked relief within a decade. Silver lacks analogous frontiers. Remaining deposits cluster in unstable regimes. Byproduct dominance ties fate to copper economics already strained by energy transition demands. If copper mines defer maintenance amid margin squeezes, alternative routes in Peru, adding 30 to 50% transport costs, the cascade erases silver first as secondary revenue. Geopolitics layers deeper instability. U.S. Critical mineral designation for silver invites tariff speculation. China's retention responds symmetrically. India's 2,600-ton import binge in September-October signals emerging buyers preempting constraints. Sovereign reserve diversification. Russia, Saudi vehicles, adds non-price-sensitive demand. Where once trade flows balance regional surpluses, now nationalism fragments access. If you've modeled industrial absorption rates, what threshold do you see triggering outright rationing among manufacturers? Share your calculations or parallels in the comments. It clarifies where allocation battles begin. The process compounds quarterly. Q1 2026 aligns Chinese New Year restocking with post-holiday voids. U.S. solar season ramps February-March. Peruvian winter historically amplifies disruptions. By mid-year, fabricators confront Q2 shortfalls, triggering forward hoarding that drains remaining buffers. Analysts project $100 to $125 per ounce by late 2026 in base cases. Triple digits if chains rupture fully. Mexico formalizes restrictions. Peru's governance falters longer. China curtails further. Yet the regime shift transcends price targets. Systems sustain when buffers absorb shocks. Silver's buffers, exchange stocks, lender inventories, elastic mine supply, approach depletion. No cavalry arrives because capital fled the sector during suppression decades. Junior struggle funding amid volatility. Majors prioritize shareholder returns over greenfield risk. Military intersections sharpen the asymmetry. Silver's irreplaceable conductivity powers next-generation systems, yet supply traces to contested corridors. Pre-crisis stockpiling was routine. Today, undisclosed accumulation suggests preparation without fanfare. If you're in defense or high-tech procurement, how are these supply signals reshaping your sourcing strategies? Your anonymous input below could reveal early allocation shifts. The fracture manifests in decoupling. Paper contracts trade complacently, while physical bids escalate. Dealers ration lots, premiums embed permanence. Delivery failures loom on futures. This isn't cycle peak. It's structural repricing of a metal transitioning from monetary relic to indispensable industrial artery in an electrified economy. Forecasts converge on persistence. Deficits through 2030, absent improbable supply miracles. Prices chase scarcity, not sentiment. Industrial users secure forward at any cost. Investors follow. Central banks diversify quietly. The phase solidifies. Control erodes. Adaptation lags. Reality imposes recalibration, measured in undelivered ounces. One remaining signal. Informal sectors in producer nations expand parallel economies, further fragmenting formal flows. Confami's demands embed chronic friction. Regulatory extensions buy time, not resolution. If you've navigated similar resource nationalism cycles, which indicators signaled irreversible tightening earliest? Your historical parallels in the comments map potential trajectories. The system crosses the threshold. Peru's corridor remains contested. Mexico's pipeline frozen. China's vaults filling. Demand unrelenting. Buffers vanish. Premiums calcify. Prices adjust upward inexorably. This defines the current reality. Cold, structural, irreversible. COMEX registered inventories drained below 80 million ounces in early December 2025, with over 47 million ounces claimed in 4 trading days, more than half the deliverable stock vanishing into physical hands. London lease rates spike again to 7.5 to 8%, while dealers worldwide ration kilobars at 25 to 35% premiums over spot. Spot holds near $67 per ounce after touching $67.14, up 128% year to date, yet physical bids escalate unchecked. this isn't correction. It's the market forcing acknowledgement. 5 consecutive deficits have exhausted buffers, and the 6th looms larger. The endpoint crystallizes because silver's structural exposure now manifests fully. Byproduct dominance, 72% tied to copper, zinc, lead, gold, amplifies every host metal disruption. Peru's corridor, contested through 2025 despite temporary lifts, erases millions of ounces quarterly as alternative routes erode margins. Las Bambas' cumulative 600-plus days offline embed chronic loss. Antamina's 12-plus million byproduct ounces fluctuate with copper priorities. Mexico's concession freeze since 2018, paired with open pit review under Sheinbaum. No new awards, environmental reassessments, locks in minus 2.9% CAGR decline. Global mine output stalls near 820 million ounces in 2024, rising marginally before resuming minus 0.9% trajectory to 901 million by 2030 amid closures. China's controls tighten the vice. Domestic production dips. Exports flood briefly, then restrict. Licenses required from 2026, favoring state-approved giants. Shanghai premiums persist above 15%, arbitraging remaining metal inward. If you've sourced from Chinese refiners, how have these licensing signals shifted your forward commitments? Your experience in the comments could highlight where flows truly constrict. Demand compounds relentlessly. Industrial offtake exceeds 665 million ounces projected for 2025. Photovoltaic alone claiming 230-plus million amid panel efficiency gains demanding more silver per gigawatt. Global capacity doublings through 2028 translate to exponential draw. 20 grams baseline, rising with TOPCon and heterojunction tech. EVs layer 25 to 50 grams per vehicle. AI data centers multiply conductor needs. 5G and defense embed irreplaceable conductivity. Subsidies accelerate. IRA and CHIPS act in the US. China's grid buildout. Europe's security pivot. India's infrastructure. No thrifting offset scale. Deficits persist. History contrasts starkly. 2011 peak resolved through primary mine ramps and byproduct surges from base metal booms. Today, permitting drags 7 to 10 years. Capital shuns $500 million plus risk in contested jurisdictions. Aging or bodies close without heirs. The 1980 squeeze burst on intervention. Current stress emerges from physics. Ounces required versus ounces movable. With no symmetric release, physical decoupling accelerates. COMEX drains force stand for delivery surges. Premiums calcify. Smaller fabricators face allocation. Paper contango narrows as backwardation threatens. Futures lag spot reality. Lease rates signal rationing. Lenders demand compensation for non-return risk. Geopolitics entrenches asymmetry. U.S. critical mineral listing invites protectionism. China's retention mirrors rare earth precedent. Informal sectors fragment formal chains. Peru's re-info extensions buy fragile calm, not resolution. India's 1,700-plus ton October imports preempt voids. If you're in fabrication or OEM procurement, what early rationing indicators are emerging in your supply lines? Share specifics below. It maps where industrial panic ignites first. The trajectory solidifies quarterly. Q1 2026. Chinese New Year plus license delays collide with voids. Q2. Solar ramps expose shortfalls. Mid-year. Hoarding cascades. Manufacturers outbid investors. Base forecasts cluster $80 to $100 by late 2026. Stress cases triple digits if corridors rupture fully. Peru governance falters. Mexico formalizes deeper restrictions. China curtails license volumes. Regime change embeds. Silver reprices as indispensable in electrification, not monetary footnote. Systems fracture at inelasticity. Byproduct tether, logistical sieges, regulatory paralysis, hoarding reflexes. Buffers gone, adaptation exhausted. Military dimensions underscore stakes. Conductivity and guidance, antimicrobial and field gear. Modernization swells demand amid tensions, yet chains trace unstable nodes. Undisclosed accumulations prepare without declaration. If you've tracked strategic metal flows historically, which parallels signal this phase as irreversible? Your comparisons in the comments refine the timeline. No reversal mechanism activates. Deficits deepen through 2030 absent miracles. New primaries deterred, recycling caps at margins, exploration starved. Prices chase scarcity, premiums permanence. Delivery failures normalize. One persistent anomaly. Informal parallelism in producers erodes formal output further. Confami demands unresolved. Regulatory truces temporary. If policy tracking is your field, how do these extension patterns align with past resource nationalism outcomes? Input below could forecast endurance or collapse. The phase defines itself. Peru contested, Mexico frozen, China guarded. Inventories depleted, demand exponential. Control dissipates, reality recalibrates in undelivered ounces, escalating bids, fractured chains. This is the sustained imbalance, cold, embedded, advancing.